Hi everyone, welcome to my first video in a series of finance for startup founders. Today we are going to talk about one of the fundamental concepts in finance called expected returns. In simple terms, an expected return is your what you hope to get out of an investment that you make. That investment could be fixed deposit, mutual funds, equity, or a lot of other possibilities there. This applies to everyone, retail investors like you and me making investments in fixed deposits or buying shares or mutual funds. This applies to institutional investors, this applies to portfolio managers. The reason we are talking about this today is you should understand that as a startup founder, when you expect a PE or VC to make an investment in your company, they are expecting a return out of their investment in you. So, today we'll try to understand both sides of the equation, and at the end, you'll understand surprisingly that the way these PEs or VCs think is not drastically different from how you and I think when we make a stock purchase. Let's talk about where people invest normally. If you're a retail investor like you, me, normal people, we have fixed deposits, mutual funds, stocks, bonds, ETFs, real estate, gold, silver. Those are the major ones. And if you're a portfolio manager, you have the same mix with additional options like derivatives. If you're a VC or a PE, you'd be investing in startups, private equities, and sometimes in public equities too. Now, how much return is expected in each cases? If you're going to bank and making a fixed deposit, you know how much return you're going to make because it's already a declared number. You know your FD is going to give you 6.25%, a fixed number. If you're investing in mutual funds or stock markets, there is no guarantee that how much return you're going to make. You are relying on historic numbers. But the actual number will depend on market condition. The same logic would apply to gold or silver or real estate. Bond investments usually give you a fixed return. That percentage would vary depending on the type of the bond, the issuer's creditworthiness, the period, etc. These are usually done by institutional investors like mutual fund companies, but retail investors also do it, but it's not very common. We talked about the concept, but now let's talk about numbers. What numbers are we talking about? A fundamental concept in investing is higher the risk, higher the return. I mean, if you're willing to take a riskier bet, you are likely to get a higher return. Risk of an asset is measured by the volatility of an asset. It's usually represented by beta. It's an indication of how the price of a stock or a portfolio would move relative to where the market is moving. Higher beta normally represents higher volatility. It means a higher risk, whereas a lower beta number means it's a low volatile stock. Now, if you're willing to take, or if you're not willing to take risk, you would invest in relatively safer assets like a fixed deposit or a bond. And when you do this, you are expecting something called a risk-free rate of return. Hey, I'm going to invest it, I need my returns, but I'm not taking risks, so I'm okay to take a lower return. In India, an indication of this risk-free rate is a 10-year government bond, which would give you something about 7% as of now. When you invest in equity, you are taking a slightly higher risk than what you are doing in the risk-free option. Now, when you take higher risk, you would expect more return from you. Historically, stock market has given you 12%, 15% returns, and the delta that you get. I mean, let's say if your risk-free is 8% and if your stock market is 15%, the additional 7% that you get is called a market risk premium, your premium for taking an additional risk. Different stocks have different volatilities and hence different beta. So your expectation out of a certain stock would be different from another one. For example, when you're talking about blue chip funds or large cap funds, they are considered to be relatively safer. So you might accept a lower return, whereas if you're investing in a small cap company, you are taking a higher risk, so you need more returns. Companies like HUL or ITC, the FMCG giants, they are normally low beta stocks. Like the beta would range something from 0.4 to 0.8. The idea is, irrespective of how the market is going up or down, people tend to consume groceries at a not drastically different quantities. Companies like Reliance Industries or HDFC Bank are considered to be medium beta companies, ranging from 0.9 to 1.2, 1.3 range. Uh, Pretty much an indication of what the overall market is doing. And let's say companies like DLF, for example, or Adani, they are high beta companies. You expect more volatility there. I'm not recommending or discouraging any of these stocks. These are just given as an example for that you can do a bit of Googling yourself. We will do a deep dive of how to calculate beta and how to calculate the returns out of it in a later stage. Now, with this fundamentals in mind, let's look at what a VC or a PE is doing. They are making equity investments just like you and me. You go to your you go to your trading platform, you identify a stock and you buy it. A PE or a VC is doing the same, but the fundamental difference is they are not buying listed companies like we do. They are trading in private equity. I'm not saying that they do not invest in listed companies. They do hold public equity sometimes, but that's not the major objective. And recollecting our earlier discussion of beta, as I said, higher beta means a higher risk. Startups are considered to be high beta investments, and when they make high beta investments, they expect a higher returns, maybe 20%, 30%, or even higher, based on what stage of the startup is and what is the perceived risk. As a startup founder, why you should be concerned about this is when you talk to these investors, you should have a ballpark figure in mind of what expectations they have in mind. Are they talking about? Do they have 20% in mind, 25% in mind, and so that you can tune your conversation accordingly. You should also remember that different VC firms would have different expectations. Some may be aggressive, some may be less risk taking, and that's the reason why a number which is acceptable to, let's say you're talking to multiple VCs, a number which is acceptable to one may not be acceptable to another. That's because they operate in different risk profiles. Understanding these expectations and help founders make more informed decisions about which VCs or PEs to approach and how to make your pitch. Hope this helps. Follow for more information.